In this video, I'll tell you why I'd rather own KO than PEP and why I think PEP is overvalued. Pepsi stock is currently trading at $167.38 with a high price of $177.24, current market cap of $231.53 billion with PE ratio of 29.78. They give out an annual dividend of $4.3 per share, a yield of 2.57% of the current price. First metric, we want an EPS multiple lower than 3. It's 5.42. It is high, but is it bad? No, not necessarily, but we have to understand why the PE is high or why the EPS is low. Based from the EPS history here, they do have low EPS. I see no anomaly here. Although I see 8 here, then 555. So you might want to look at that. It is slowly increasing though. OSN is number of shares. It is going down, which is good. So 2 checks already. Payout ratio is high. I want this below 60% personally. So at these levels, I'd say their dividend is at risk. Second metric, we want to pay $1 or less for 1% of the money they're making. Meaning, we want to pay 1 PE or less for 1% of their margins. This is based on the lowest margin between the net income and free cash flow margins of the current year and the average of 5 and 10 years margins. What you see here is revenues deconstructed, the costs and expenses the company uses to make these revenues. The net income here is after taxes already, and free cash flow they generate off of those revenues. From this revenue growth of single digits, I won't be paying premium for the stock. Of the 4 highlighted values, I used 8.8, the lowest margin, to divide the current PE, and we'd have a premium of 3.39. This means we're paying 3.39 times their margins if we buy the stock at the current price. This is expensive, guys. And this is why I'd rather own KO than PEP. Now, their argument would be, why not pay more? They make more than KO. Well, guys, we have to look at companies by themselves, individually, not really compare them. We have to look at stocks at eye level, all equal. So if KO were to make these revenues, they'd be making more than PEP. Then PEP trading at these PEs wouldn't make sense then, right? Again, guys, if you're fine paying 3.39 times their margins, buy the stock. Maybe this is a growth multiple, sure. But 3 times? This is more expensive than tech stocks. So why not just buy tech then? Third and last metric, historical PE. The metric suggests that the stock is trading at a higher PE now, at 2.14 times their average historical PE. In conclusion, the stock is overvalued as it trades at 5.42 times their earnings, 3.39 times their margins, and 2.14 times their historical PEs. I don't own the stock. I don't think we should pay premium for the stock. I'd rather buy KO than this. I have a fair value of $48. Intrinsic value is $61. This is from Guru Focus. These are my entry PEs, 8, 9, 10. I think it's only fair if you look at their margins. And 8, 9, 10 is already with my margin of safety. And that's not even by much. Using these PEs, here are my entry price. I have a high price of $55. Meaning, by the current price of $167.38, it is expensive by 3.05 times my target entry price. So, I guess I won't be buying this. I'd rather own Coke. For the sake of mapping, where Pepsi is trading at for EPS growth 10%, use 1.25, 1.5 for 20%, and 175 for 30%. I have a high price of $96. Guys, even with my multiples, the stock is still severely overvalued. At the end, I'd avoid the stock until their EPS finally catches up and justifies the current stock price. By charts, I'd easily say this is overvalued by this run here from the COVID bottom. If we look at KO, well, it didn't move that much, while Pepsi, I think, went crazy. My entry price is $55, so I think it's just impossible we'd get that low. So, yeah, I'm not a buyer of the stock, and this is easily in my avoid list. This three metric I use is designed to determine the best PE to buy a particular stock, as I believe PE is the price we pay for in a company. This is my process of screening stocks to buy at what PE by looking purely at the company's financials and none of their fundamentals. If you like to invest in these companies, I'd advise you to look at their fundamentals, their charts, and more of their financial data and metrics like long-term debt, some important financial ratio, etc. As always, do your own research.